Welcome back to part 2 of getting tired of losing your money in the market, and let's just get back right to it. Thanks. Now, why would the media not tell you this? Do you ever wonder who pays the media's bills? Advertisers, right? Do you think Wall Street firms advertise in the media? Do you think that Wall Street could control the message that the media puts out? Do you think that the media would continue to get advertising dollars if they were out there telling consumers how to avoid paying the fees charged by their advertisers? Is it possible that Wall Street is somehow controlling what the media tells you? See, what Wall Street doesn't want you to know is that there's no way for the market to not be at risk for loss. And losses absolutely kill investors. Face facts. You've been betrayed and you have every right to feel angry. That's another myth uncovered. Advisors that are market-based talk about how they have a fiduciary responsibility to you and that they're doing what's in your best interest, when in reality they are likely doing what they can to generate the most fees for the longest period of time. Do you know how much power losing money in investments contain? See, losses hurt twice as much as benefits gain you. If you lost 10%, you know how much it would take for you to get back to even? It takes 11%. If you had 100 grand and you lost 10%, you'd be down to 90,000. To get back to 100,000, you'd need $10,000, right? Which is 11% of 90,000. It doesn't sound like a lot, but it is, and it gets worse. A 20% decline requires a 25% increase to get back to even. And remember, back in 2000 to 2003, the market was down 46%. It took a 72% gain to get back to even. $100,000 loses $46,000. You have $64,000 left. It takes a 72% return on $64,000 to gain the $46,000 back. Our most recent decline of 59% would take a 144% increase to get back to zero. Now, the market's rebounded about 30% this year. Let's see where that would leave your $100,000. You went from $100,000 to $41,000 when you lost the 59%. A 30% gain on $41,000 is just $12,300. So now you're at $53,300. Looks to me like you're still down 46.7%. Here's some tidbits to think about. Since 1950, which is 58 years to the end of 2008, the market's been up 42 years and down 16. That's up 72% of the time and down 28% of the time. In 10 years, you typically have 7 up years and 3 down years. The gains in the up years are more than 8%, 76% of the time. They're more than 10%, 69% of the time. And more than 12%, 64% of the time. While the losses are down more than 8%, 75% of the time, more than 10%, 69% of the time, and more than 12%, 44% of the time. That tells us when we're up, the ups are pretty good, but when we're down quite a bit. All right, well, let's use those numbers, and let's say a 10-year period of S&P 500 market performance was up 4%, then up 11, then down 8, then up 20, then up 6, then down 11, then up 16, then up 8.5, then down 15, and then up 12. So you've got 100 grand. Would you rather put that in an indexed fund where you're subjected to those ups and downs of the market that I just lined out, or something that can earn a steady 4.5%? In the market, your 100 grand is worth $144,063 at the end of 10 years. In the one that's earning 4.5%, it's worth $156,699, which is $12,636 more, or 8.77% higher. Are you starting to see the power of losses? Did I manipulate the numbers in the market? Well, yeah, I did to some extent. But what I did is I took out any huge gains as well as huge losses. I used the statistics from the last 58 years to make it look like, perhaps what the market looked like in the past 58 years. It was up 7 years, it was down 3. It was up more than 8% 5 times, up more than 10% 4 times, and more than 12% 3 times, and down more than 8% 3 times, down more than 10% 2 times, and down more than 12% 1 time. Do I know if this would ever exactly happen? No, but it's certainly within the realm of possibilities. The point of this video is that even though the governing bodies of market-based advisors tell you that you can mitigate risk of loss by diversifying your investments, as long as you have money in the market, you cannot eliminate the risk of market losses. And contrary to popular belief, there are ways to safely earn guaranteed rates in the 4s and 5s without being in the market, without the risk of loss, and can provide a lifetime of income in retirement. Something that market-based investments like stocks, mutual funds, and exchange traded funds just can't do. Do you know when the down years in the market are coming? Neither do I. Neither does your advisor. Now, since we don't, would it make sense to look at safer alternatives that can over time potentially deliver better results than the market? If you'd like to know more about safer alternatives, please call me, Kurt Jackson, at 816-582-5532, and I'll be happy to discuss them with you. Now, don't forget to go back to www.financialsensetv.com to find more educational videos about financial topics that are prudent for today. And if you don't see a topic you'd like to see covered, email me at Kurt, K-U-R-T, at financialsensetv.com, and I'll be happy to try to do some research and put one up. Thanks for listening.